Hey everybody, Chaley Ridge here, Ridge Lending Group. So this is part one of a two-series recording that I am going to be doing today for our Live with Chaley events every weekday, Tuesdays at 1:30 Pacific, 4:30 Eastern Time. As most of you know or remember, I will be not there live Tuesday the 2nd or Tuesday the 9th. So these are going to be available to you probably the night before. Feel free to download these and check them out at your leisure. And the content is going to be about certified power buyer. This is a unique offering, I think, that Ridge provides for its investors that really does some deep dives into the qualification part, the education qualification part of real estate investing, how it relates to you specifically and your goals today and your qualifications today. And then most of all, it really takes all of that information and it teaches you how to optimize your qualifications for long-term success. If any of you have had these conversations with me one-on-one over the course of the last, I don't know how many years, you know that they're very subjective to you specifically and what it is you're trying to get out of this. But you also know that as you evolve as real estate investors, your qualifications are going to change over time. Your debt to income ratio is not going to start at 20 and stay at 20. It's going to be fluid and change as you buy properties and sell properties and file tax returns and acquire new properties, all of that stuff, 1031 exchanges, all of that is going to make a difference in DTI. Same with credit, same with assets. Those things are not going to be a straight line. So I really want to empower you with information that shows you how to keep these things at their very optimal levels so that when you're continuing to invest, whether it is purchasing or refinancing, you're doing so and attaining the best rates and terms those qualifications can afford you, right? It makes sense. I'm a big proponent of education. I hope that you are too, and that's why you're listening. So without further ado, let's just kind of get into this. So part one, I'm just going to kind of talk about a few expectations about these calls, and then within those expectations, kind of summarize what each of the individual calls will be about. And then I'll move on to a part two. So I don't have an actual time here. I'll figure it out as I go. And then just as a reminder, I just made another video too, guys. On the 16th of May, I'm going to be marketing the hell out of this. I'm so excited. So I hope that you're going to be there for guest speaker John Digman. He is an appraiser with tons and tons of experience, specifically non-owner occupied, what most of us are talking about here. And he's going to be able to show us how to read an appraisal, what the different adjustments mean, how the investment properties add into that, the 1007, which is where the rental income comps go. Lots and lots of good content. I had a great conversation with him. So please, if you are available, I think you're not going to want to miss the 16th of May, 1:30 Pacific, 4:30 Eastern. Okay, certified power buyer. As I just described, is a way in which I can get with my clients one-on-one individually and talk to them about what their goals are. What are they trying to do, short term and long term? 12 months, we say short term, and then we go into 5, even 10 years down the road as a long term, and really defining what that looks like for them, and then kind of digging in further about where are their priorities or their focuses. Are they just looking at long term? Are they just looking at single family? Are they just looking in one particular market? Is the price point range just 100,000 and below? What class, asset class, A, B, C? Are they investing in alternative means of real estate via syndications or private notes, that kind of thing? I want to gather all of that information up front so that I can maybe provide a little bit of feedback as it relates to what I know, what I've been through, some of the pitfalls, the wins and the losses over 25 years, that if I can provide a little bit more information that kind of opens up the playing field and allows an individual to be more informed, so that their results and their success through real estate investing is at its highest, right? That's my goal. And I always tell people, you know, I'm often trying to play devil's advocate or provide some context about things largely based on my own experiences. You're going to take what you want, you're going to leave the rest, right? This is my 1.3 cents worth, as I like to say. Take what you want, leave the rest. So our first call in CPB, part one, and I think I failed to say this, each call is about 30 minutes in duration. I like to keep them in good chunks like that. And we're going to have anywhere from 3, 4, maybe even 5 different calls, depending on how much Q&A there is, those rabbit holes that I tend to go down, any left turns that we make, whatever. So Anywhere from 3 to 5 different calls, 30 minutes each is what you can expect. The first call is really going to be about those goals that I just described. And then part two is usually going to be reserved for credit and asset discussion. I'm going to get into what are the definitions from an underwriting perspective as they apply to you and your credit score and assets today. What does it mean, right? I think I'm repeating this, but I think it's important. How do you define what your credit score needs to be when you have one property or you have 10 properties? And does it change? Absolutely, it changes. So being prepared for what comes next, I think is very, very important. And how do you keep your credit score at its highest? So we're going to look at your credit report. I'm going to show you some different things that may not have been obvious to you on how to keep that credit score highest. We're going to talk about things like rapid acquisition, which is a big one that can derail credit scores without you really even knowing it. I'm going to display some myths about credit score. Then we're going to talk about assets, what types of assets are allowed or considered, how are they applied, and like credit, how does that change as you continue to acquire more property? Will it change? Yes, again, it's going to change. The more properties you have, typically speaking, the higher the bar is for what the requirement is in underwriting. So we'll look at those definitions. And then we're going to take all of it and put it all together and get ready for a part three. So that would be part two. Part three, typically I like to reserve for debt to income ratio on its own. I can usually keep credit and assets in one call because those are relatively simple to follow, nothing too crazy in there. But the debt to income ratio um, can get a little squirrely, especially if you're self-employed and you have lots of businesses or lots of K1s. Maybe you have lots of properties and a really big, long Schedule E. Debt to income ratio can be, it's kind of the meat of all of it, actually, I would say. And it's very heady stuff. So I like to keep DTI on its own for retention purposes. I think it's wise. But we're going to do some deep dives into the differences between, and again, this is part three. So part one is goals. Part two, usually credit and assets. Part three, DTI. And real quickly, let me mention too, gang, while I have a structure that I'm kind of outlining for you here, I really want to keep these calls as fluid and collaborative as possible. So if there are things that are top of mind for you that are very important that you want to dig into, maybe there's an investment that you're looking at in the Smoky Mountains, whatever, that we want to spend our time doing. We can certainly do that and then get back on track. So please keep in mind that while I do have this structure, I do want to make sure that you know that we can take those left turns or right turns or whatever and talk about things that are top of mind for you. Okay, so back to, actually, you know what? I think I'm going to pause there. I'm going to use the debt to income ratio for part two of the certified power buyer. Otherwise, what you can really get out of this is going to be high level, real time, under the hood, black box kind of stuff. This is not Dr. Google, Dear Google stuff. You can't get this just by searching online. And even if you could get it, it's probably either outdated, not applicable to you, or straight out wrong. I see it all the time. And because I live and breathe and eat and sleep in this space, I really have my finger on the pulse. So I'm able to impart real time how it is going to apply. And I can even try to forecast how things may be evolving and what changes to expect. So I think that's going to be some important information for you. Now, in part two, I'm going to wrap up here. So this is actually, I got through this a lot faster than I thought. So for part two of this video, I'll get into what we talked about for the LLC, or excuse me, for debt to income ratio, just an abbreviated idea of what that consists of. But also, if there's time, and maybe not, usually we make it a fourth call, part four for certified power buyer. We'll talk about LLC for those of you that have any interest in that for asset protection. There's some details that I like to share about, you know, again, based on my personal experiences, what I've done, what I've not done, what I've done right, what I've done wrong. You guys will take everything that makes sense to you, do your own due diligence. I'll probably say this again on the next video, but I am not an attorney and none of this is implied or meant to be giving you legal advice, okay? This is my own personal experience, 25 years in doing this. So there you have it. I've covered my legal butt. Okay, so but part four, probably LLC, if anybody has any interest in that for asset protection. And then finally, what we're going to do is we're going to come together and really take it and come up with that certified buying power as it relates to what you've learned and your goals. Okay, so that's this video. I hope you guys got a good understanding, at least um, uh, roughly what you can expect for certified power buyer. Those are the part one, part two, part three, part four, maybe a part five based on variables I've described. Otherwise, I'm going to get now and turn this guy off, and you're going to see a second video on the ninth describing debt to income ratio and some of the LLC stuff. I hope you guys do take advantage of this. It's kind of cool. It is one-on-one, and I think if I didn't mention already, it is free. My time is free. It's actually one of the best parts of what I do. It's my favorite part, being able to talk to my clients one-on-one and really dig into this stuff. So hope you take advantage. Talk to you soon. Hi, everybody. Again, how are you? I miss you guys. I've just been thinking about it, and it's going to be 2 weeks before I see all of you for our Tuesdays live with me. So it'll be great to be back on the 16th. This is part two of the certified power buyer expectation that I'm going to be setting. I just finished recording part one, and I realized that you guys get to see Benny Biscuits. I didn't notice that in the frame. That's our mascot. That's Benny Biscuits. Hey, BB. So I don't know any of you that haven't seen him before. This is the one of the loves of my life, the great loves of my life. Okay, thank you for tuning in and listening. So I want to talk about and these recordings. I thought I would have about 15 minutes each, and I think that they're not going to be. The last one I just did was about 10 minutes. This one might be even shorter as I kind of wrap it up. So just to get started on that, certified power buyer is going to be, just recapping quickly, it's going to be anywhere from 3 to 5 different 30-minute calls where we talk about what your goals are, what your qualifications are today, some definitions about those qualifications from an underwriting perspective as it meets with where you are today, and then teaching you effectively how to optimize those things. And then we round everything out at the end and get into planting seeds and creating roadmaps so that you are meeting milestones as they relate to your goals, and then making sure that those qualifications are in line as well. So that's kind of the gist. On my last video, I talked about part one, part two. I started to get into part three, debt to income ratio, so I'm going to pick up there. So debt to income ratio is normally, it falls on part three. Remember that this is a fluid conversation and one in which that I am very happy to keep loose so that we can cover different topics that may be important to you. But if it goes as planned, debt to income ratio will be for part three, and that's where we're going to really discuss the definitions in underwriting as it applies to conventional loans. Maybe it's a non-QM loan, maybe it's a bank statement loan inside a non-QM, maybe it's a debt service coverage ratio. So based on wherever you are, the conversation will be dictated on those details. But more often than not, we're going to take time on a full doc, usually conventional. It doesn't always have to be a Fannie Freddie loan when you're going full doc. And full doc is going to be, you know, files of blood DNA samples, pay stubs, bank statements, tax returns, W-2s, all of that stuff. And when we get into that, we're really going to take a close look at the ways in which rental income is used to qualify. There's two ways in which we are going to look at rental income, something called the acquisition year, applicable from the day that you've purchased the property, acquired the property, and until that year's tax return is filed. That is a very, very simple formula. It comes with some other details that will be important to learn, and how it's applicable and who it's applicable for, this acquisition year formula, that we can get through fairly easy without too much brain damage. But then we're going to go into the Schedule E formula. Now, this is wildly more complicated. There's lots of visual aids on this call, and even the prior calls that I spoke about in my last week's video. But we're going to look at Schedule E tax returns, example tax returns that we've used and we've redacted appropriately. And then we're going to look at pre-formulated Excel worksheets straight from Fannie Freddie calculation. And we're going to see what we pull from where and where we put it. And if you have rental properties, this is very, very useful because you can see it real time and as it applies to you particularly versus just the examples. But getting an idea and seeing how the pluses and minuses work within the Schedule E, I think is so powerful and so useful because you've lifted back the veil, right? You got to see the wizard and the ingredients in the cake and understanding this is what goes into it so that you can prepare. Well, we're going to be the ones probably to help you prepare on an annual basis for how do you want to file this year? Right? We talk about this a lot in our community, or I've talked about it over the last year and a half a lot in the community. And I think that people recognize how powerful it is to have that information related to your debt to income ratio as a real estate investor. So we really go into a great deal of detail to discuss all of that, what the add backs are, what you can't add back, how much do you want to maximize that year deduction? When do you think that you're going to be in a position potentially to take advantage of the real estate professional exemption? That's something else that we discuss, so on and so forth. So part three, typically real deep dive into debt to income ratio. I make a stupid joke. For those of you that have done and done CPB with me one-on-one, you're going to remember this one. But the morning of debt to income ratio, I want to make sure that you have a good breakfast. So if you're an eggs and bacon kind of person, make sure you get your brain food because this one is going to be tough. And a lot of times too, gang, it's not uncommon for us to do debt to income ratio twice. It is a lot of information. And I know for me, I need to hear something and see something and do something, maybe even hear it 2 and 3 times before I really can retain it. So if that's the case, feel free. We'll make sure that we take as much time as we need to. Um, and that's going to be debt to income ratio. If we have time, if we get through it quickly enough, we can then take part three and touch on LLC for anybody that has any interest in that for asset protection, the different types of LLC, how many properties do you put in an LLC? Do I want to have an LLC in the state that the property is located in? Is the LLC necessary? What about a trust? What if I just got an umbrella policy and blanket insurance that covered $1 million of liability, and maybe I don't need the LLC. Oh, Benny's Ride is here. I'm recording to my fans. No, it's okay. It's for next week. Thank you. Sorry, gang. That'll just be a little fun peek into the day in the life. So LLC. So a lot of that is going to be subjective to what your comfort levels are. All of my properties have always been held in an LLC. Has that been necessary always? Not necessarily. I'll go into that if and when we get there. And that should be part three if we get through it. Maybe LLC is put into a part four. And then finally, we're going to wrap all of this information up, okay? And we're going to come up with a schematic that outlines and details for you where are you today, okay? We need to know what your baseline is. That'll have been defined already for us. We already know what your goals are. You want to have 5 properties in the next 12 months, and in 10 years time or 7 years time or 3 years time, you want to have amassed $10,000 a month of passive net income. Okay, so we have all of those variables. Now we can solve for those things, knowing what we know about the products, the loan products that we have, and some expectations about where you're going to be and what you're going to be able to amass along the way. And then we can kind of create the milestones that say, okay, by the month 28, this is where we think we should be. And there's going to be a lot of time in the middle where we reconnect and maybe things have changed. Maybe we had to pivot because this happened, or excuse me, or maybe we've changed our strategy and now we're really just going to focus on short-term rentals. We have to come back to the well and kind of rejigger where we thought we were going to be and set new expectations for ourselves and what our goals are going to be. So the certified power buyer final call is going to be about really putting pen to paper and making sure that we have a great outline, that roadmap that I'm always talking about, planting those seeds along the way so that we are meeting our goals within that reasonable time frame, or that time frame that you have designated to hit, and whatever that means for you, whether it's total replacement of your current ordinary income through real estate, or maybe it's supplementation. A lot of times clients love what they do. Our investors love what they do for their W-2 job, and they'll always do that, but they just want the freedom potentially to choose how much of their time is spent doing that because they have this retirement passive income over here. Whatever the case may be for you, isn't really important. It's not a one size fits all. So everybody is going to have their own unique circumstances. Um, but I think that sums it up. That's another almost 10 minutes here. You get a good idea, I think, of what goes into these certified power buyer calls. They are all video calls, by the way, and you're going to want to be in front of your computer when you do these, ideally. I do have clients that are, on the road throughout the day. I have a police officer, in fact, I wonder if he'll hear this or see this, where he does it from his police car, right? He's got, I think, probably a laptop there, and I'm able to share screen and do some of the visual aid stuff that I was talking about, and we get it done that way. So, but otherwise, you do want to have a computer and internet, and there'll be video calls, and it's a good time. I think you're going to enjoy it. So for those of you that are brave enough and want to take advantage of this, I look forward to connecting with you on these one-on-one calls. You have to sign up. You want to talk to your dedicated loan specialist about how to do that. You have to have an application in. We have to have credit pulled, all of your updated income and other documentation that's required in order to take advantage of this. But otherwise, yeah, it's time with me, and I think that it's valuable. That's my opinion, and I'm sticking to it. Okay, guys, so that's it. This is the 9th of May. You'll be watching this. I will be back live with you on the 16th. I'm going to be getting some sun and hanging out and doing some road trips with my family in Tucson. And that's what I'm going to be doing. So I'm excited about that. And then the 16th, you'll be seeing some posts and some marketing stuff that's going to go out. It's with the appraiser, guest speaker appraiser that I've been mentioning. It's going to be awesome. I spoke to this person yesterday, and he is a wealth of knowledge. I'm going to learn some things. I'm certain of it. I've got some questions, some under the cover questions for him, see if we can stump him, see if he can answer some. And I would encourage you guys to come with your own questions, right? If you've been on the other side of having an appraisal that came in low, or that you didn't agree with comps, or whatever it may be, have your questions ready. He'll be able to take those for us and answer those for us. I anticipate that call is probably going to run over the standard 30, maybe even up to an hour. So if you want to set aside some additional time, I think that would be a good idea. Otherwise, I will see you then. Thanks all. In the meantime, if you need anything, obviously you have direct access, info@ridgelendinggroup.com. Call us toll free, 855-74-RIDGE. You can get on our website, fill out an application, all of that stuff. We are at your service. Talk to you guys soon. Thanks.